to our single leg options trades analysis. Okay, it'll be on a dashboard which looks at single leg option trades, and we analyze them from a couple different perspectives.
All right, perfect.
Yep,
Share your screen whenever you want. Thanks.
I'll share my screen here. And let's go to the SPY. And really here, what I'm going to do is I'm on SPY here, and under options, we're going to pull up the single leg dashboard, like by clicking over here. And let me just expand the screen here a little bit, and we'll talk about some of the new additions we added to this report. So over here, we have, these are all the contracts that traded that were reported as single leg, call or put trade, which means it wasn't part of a multi-leg trade or contingent trade. So you could see 6.5 million contracts out of almost 8 million. And this is the breakdown percentage of calls versus puts. This is our interpretation of bought versus sold. And then over here, these two boxes here are new. Okay. And we added some more new features as we go scroll down. Right. And up here, this shows us the most active options that had single leg trades. This is only looking at the single leg trades. If it had multi-leg trades, it wouldn't include it in here. It's only looking at the single leg trades. And what we have here is the option. So you can see here, June 5th, 535 call, traded 30,131 contracts just on this in single legs for a VWAP price of 7 cents. So this is the volume weighted average price of all those single leg contracts in that call. Okay. And so on. The next one is the June 5th, 533 call, VWAP price 53 cents. And you can see here, then there are two puts and another call, and they're all on the June 5th expiration, and really in SPY, because almost every day the most active options are those 0 DTs. So it's not a surprise that all of these are going to be the 0 DTs, or most of them will be the 0 DTs in SPY. But these are the most actives, and they all look, around where the at the money prices are. So you could see yesterday we closed at 534, but it had a big range from 528 to 534. So yesterday was a pretty wide range of trading in SPY. And I think that's why we see, strikes between 530 and 535. And this blue is indicating, where we see the highlighted option in blue with an underline. What this is a hyperlink. So when you see that, if you click on it, it'll take you to the options chain for analysis. So if I click on it like this, what it'll do is take us to the options chain in SPY. It'll take us to that June 5th expiration. And what it'll do is kind of just auto-populate. If you wanted to run an analysis on that call, it'll just auto-populate June 5th call, 535 call. If you run analysis, then you're going to get all these statistics on the call. So you could see here, what it did yesterday, from 9:30, you could see it started out over here, it got up to 15 cents, came back down. So let me close this for now. Come back here. And now let's take a look at this on balance volume by Greeks. And what this is doing is taking the single leg trades and interpreting how that order flow from end users or takers is coming in. So when we look at the market structure, we have liquidity providers, which we call market makers. It could be a specialist, it could be a market maker. It doesn't have to be a broker dealer. It could be somebody putting in, limit orders. And then we have market takers. Those are the ones that are trying to more aggressively go in and get a fill, right away, or trying to get a price improvement, but they're market takers. They're more of the initiators. And then we take those trades and we take the volume, and then we say, well, here are buyers and sellers. And then on balance, if we subtract buyers and sellers, if there's exactly the same amount, it will go to zero. If there's more on one side, then there'll be an imbalance. And we convert that volume to the option Greek. So we could take a volume of one option, like let's say there's 1,000 calls traded for an option that's a penny way out of the money, or 1,000 calls that are at the money. Well, they're going to have a different delta, right? An out of the money call, that's a penny, the stock might move around, but the penny, it won't change the price of the option unless the stock really moves up. But at the money, the option has more sensitivity, has a bigger delta, and that option will move around as the stock moves around because it has a higher sensitivity to option movements. We call that the delta. And so this is showing us on balance, how much deltas, if we took all the positives and negatives, on balance, we interpreted a negative 943,000 deltas. What about the gamma? Well, what's the gamma of the option? The gamma is the rate of change of the delta, because your delta doesn't stay the same, right? So your gamma means that as the stock moves, the gamma is telling you how much your delta would increase or decrease, right? And that's measuring the rate of change of the delta. And here we had measured that there's negative 7 million gamma. And that's not a surprise because most of these options are zero DTEs. So zero DTE means that they're going to expire, right, at the end of the day. They have a lot, so they have a very large gamma, right? They're going to be very sensitive because by the end of the day, at expiration, they're either going to be out of the money and worthless, or they're going to be in the money and they're going to be go to 100 delta. The price of that option is going to be worth whatever parity is, difference between strike and the stock price. So what about the Vega? Well, the Vega is showing us how much volatility, by volatility, on balance we have. So if there's a lot of selling in options with high Vegas, especially like more out of the or longer dated, they have higher Vega. There's a lot of selling on balance. People are selling Vega. If they're buying, they're on balance buying Vega. And then the theta is how much those options on balance are going to expected to decay for 1 day's as 1 day passes. Okay, 1 day's decay. So this is kind of just giving us a glimpse picture of how that order flow seems to be moving. So let's see if that makes sense. So if I'm going to slide down here, so here's what the term structure looks like in SPY. Okay, so here we have the volume of trades. And we could see here June 5th received most of the options volume. Even if I slide down here to this table, 50% of all the single leg trades traded in those zero DTs, half of all the options trade. options volume. Then the next one you could see is June 6th, one day to go. That will be today's. That was 16.5%. And you could see we have the table here. It keeps tapering off. So it's very loaded towards the very short term options. And that's why we see a big gamma and a delta, because they're very sensitive to price movements as the options get closer to expiration. They're bigger gamma, bigger delta, right? And that will make sense why we're kind of seeing this. What about the Vega? Well, the Vega could represent the options that are expiring have very low Vega. In other words, they're basically going to expire today, right? So the premium is just whatever the day is left over. So they're not as sensitive to an implied volatility move of, one vol click almost is meaningless to an option that expires the same day. Okay, but an option that has longer days to go is more sensitive to Vega. And so here's what we see. This is the term structure, and there are two lines here. One is a dotted line, and one is just a gray line. And the gray line represents the implied volatility the day before. The dotted line is the new line representing the implied volatility, the most recent volatility. So we could see the change, right? Just like you want to see the change in the stock price. Well, we want to see the change, the 1 day change in the term structure. How did the implied volatilities move across the board? If we looked at from short dated to longer dated options. So here we see what happened was the front two expirations, implied volatility, the red means it declined. So decline, maybe more selling pressure, right? That's kind of like what we're seeing here in the gamma. And the longer term, as we go out, they ticked up a little bit. So here's the at the money. So here's the at the money, and then you could see that at the money strikes ticked up. Okay, which could indicate that there's a little bit more buy pressure. Either the dealers are lifting it or there's more buy pressures, which would explain why we see a positive on balance Vega. So it's kind of making sense here from these interpretations and what we're seeing, the changes in the term structure. Okay, so we could see that, yeah, the for the most part, there's lots of selling going on in those front two dates, which I think is typical from day to day. I mean, that's what you usually see in SPY, from day to day. That doesn't mean you'll see that every single day, but more often you'll probably see that. That's how people on balance use SPY options, and they could have other options out there that they are long offsetting. We don't know, right? But that's kind of what we see more often than not. So here, now we kind of, get a sense of the balance, and does it match up with how the prices moved, and in this instance it does. So it kind of explains away what may be going on. And we don't see a lot of volume down here, at least not compared to this, to the 2 million contracts that traded on the expiration. But if we wanted to look at the table, we could see how many contracts for each expiration. We could expand this, to see how many contracts traded at each expiration. Another quickly, we talked about these over here already. So another feature that we did add to these notable trades is this hyperlink that takes you to the options chain if you want to analyze it. So the difference here between notable trades and most active options is this takes the cumulative trades. So these are taking all the trades. It could be, there could be a 1 lot traded, a 10 lot, 1,000 lot, 100. It takes all of them, accumulates all the volume, and then takes the weighted average price of all of them throughout the day. So there could be many, many trades going on. It doesn't have to be one trade. So that's what this is, the cumulative volume per contract. This here looks at notable trades, any big trades that happen, either traded, one block trade or traded really quickly that we determined was all part of an order that swept the order book. And here, now we see something a little bit different, right? Because here, June 5th, we see lots of volume, but that could have been just distributed amongst, many different trades. And that doesn't mean one trade happened with 300,000 contracts. Here, these are looking at just large trades, single trades. And here we get a little bit different picture because now some of them are going out, further in time, longer dated. We see one August 16th expiration, the 510 put. We found a trade that traded 7,000 contracts for a VWAP price of $3.57. And we interpreted it as an incoming buy order. Okay, here's one. This happened on the 0DT, June 5th, 532 put. We saw a 5,497 trade for 43 cents. We interpret it as an incoming buy. Bought. Here's July 19th, 507 put, 3,700. We interpret it as a sell, and so forth. So if you wanted to go click on that. Oops. So let me see. If you click on that, remember the hyperlink, it'll take us to the options chain. It'll populate that particular option, right? So this was at 357. That was where that were traded. $3.57. We could run that and